President Trump's shifting economic and tariff policies are fueling economic uncertainty.
You've probably heard that countries like China and Japan hold a lot of U.S. debt. It's a topic that pops up regularly in the news, and often it raises a few eyebrows. But what does it actually mean when we say foreign countries own U.S. debt? Why do they buy it, and what's in it for them? To understand this, we first need to look at how the U.S. government borrows money. When the government runs a budget deficit, meaning it spends more than it collects in taxes, it needs to raise money to cover the shortfall. One of the main ways it does that is by issuing Treasury securities. These are essentially IOUs, or promises to repay borrowed money with interest at a future date. They come in different forms, like Treasury bills, notes, and bonds, each with varying lengths of maturity. Now, these securities are sold to a wide range of buyers: banks, investment funds, pension schemes, and yes, foreign governments. When another country buys U.S. Treasury securities, what it's really doing is lending money to the U.S. government. In return, it earns interest on those holdings. But unlike a normal loan between people or businesses, this kind of lending is often tied up with much broader strategic, financial, and economic goals. So why would a country want to lend money to the U.S.? After all, wouldn't it make more sense to invest in their own economy or fund domestic programs? The main reason is trust and stability. U.S. debt is widely seen as one of the safest investments in the world. That's not just a marketing slogan. It's based on decades of consistent repayments and the sheer size and influence of the U.S. economy. The U.S. has never defaulted on its debt in modern history, and that level of reliability gives investors, including foreign governments, a strong sense of security. The U.S. dollar also plays a huge role in global trade. It's the most widely used reserve currency in the world. In fact, around 60% of global foreign exchange reserves are held in U.S. dollars. That means when countries trade with each other, even when the U.S. isn't directly involved, they often settle those trades in dollars. As a result, many nations naturally end up holding large amounts of U.S. currency. Take countries like Japan and China, for example. These are major exporters, especially to the U.S. Every time an American consumer buys a car from Japan or electronics from China, money flows from the U.S. to those countries. Over time, they accumulate billions of U.S. dollars. Now, holding on to all that cash isn't necessarily ideal. Just like you wouldn't want to keep all your savings in physical notes under your mattress, countries don't want their foreign reserves to sit around doing nothing. That's where Treasury securities come in. By buying U.S. debt, these countries can safely store their dollar reserves while earning interest. It's a low-risk way to keep their money working. At the same time, this strategy helps keep their own currencies relatively stable. If they were to suddenly convert all those dollars back into their local currency, it could drive up demand and cause unwanted swings in exchange rates, potentially making their exports more expensive and less competitive on the global market. There's also a broader monetary policy angle. Central banks, which manage a country's currency, money supply, and interest rates, use foreign exchange reserves as part of their toolkit. Having a healthy stockpile of U.S. Treasuries gives them flexibility during times of economic stress. They can sell those securities if they need liquidity or want to influence exchange rates. In some cases, buying U.S. debt is also about maintaining strong economic and diplomatic ties. When two countries have deep financial links, like one holding large amounts of the other's debt, it creates a form of mutual dependence. It's a bit like having skin in the game. If one economy struggles, the other feels the ripple effects. This interconnectedness can encourage cooperation and reduce the risk of conflict, at least in economic terms. Recent data from the U.S. Department of the Treasury shows that as of January 2025, foreign holdings of U.S. Treasuries stood at $8.526 trillion. That figure reflects a 7.2% increase compared to the same time last year. Japan remains the single largest foreign holder, with $1,079 trillion, followed by China at $760.8 billion. These numbers fluctuate from month to month based on a variety of factors, including exchange rates, interest rates, and political developments. But the general trend has been one of sustained interest in U.S. debt from a wide group of countries. It's important to note that these purchases aren't limited to individual nations. Some of the holdings are tied to financial centers like the Cayman Islands or Ireland. These places serve as hubs for global investment funds and multinational corporations, many of which route their investments through these jurisdictions for tax or regulatory reasons. Another interesting point is that foreign governments aren't buying treasuries in secret. The U.S. Treasury regularly publishes data on this through its Treasury International Capital, or TIC, report. This report shows which countries hold U.S. debt and how much they hold. It's released monthly, though the data is always about 2 months behind. So, for example, the report released in March covers holdings as of January. One reason why countries might slightly adjust their positions from month to month has to do with interest rates. When U.S. interest rates are high, newly issued bonds pay more, making them more attractive. But that also means older bonds, the ones with lower interest rates, can lose value if sold before they mature. Countries may shift their portfolios to maximize returns or manage risk. Political stability also plays a key role. While the U.S. isn't immune to political turbulence, especially in election years, it is still viewed as a relatively predictable and rule-based environment. That reputation helps keep demand for U.S. Treasuries strong, even when uncertainty rises elsewhere in the world. There are, of course, some critics who argue that foreign ownership of U.S. debt gives other countries leverage over American policy. The idea is that if a country like China decided to suddenly sell off a large chunk of its holdings, it could destabilize financial markets or push up interest rates in the U.S. But most experts agree that this risk is overstated. Such a move would likely hurt the seller just as much as, if not more than, the U.S. It would drive down the value of the bonds they still hold and potentially damage their own economy in the process. It's a bit like setting fire to a house you're living in. In summary, when countries buy U.S. debt, they're not doing it out of charity, nor are they secretly trying to take control. They're making calculated financial decisions based on safety, liquidity, and economic strategy. Treasuries offer them a place to park their U.S. dollars with minimal risk, a steady return, and built-in flexibility. While foreign governments have long considered U.S. debt to be a safe haven investment, recent data suggests that some of that trust may be starting to shift. Between late 2024 and early 2025, something notable happened. There was a significant wave of selling among foreign holders of U.S. Treasury securities. This movement raised eyebrows in both financial and political circles and sparked deeper questions about the future of U.S. debt as a preferred global asset. To understand what's going on, we can start by looking at the official numbers. Every month, the U.S. Department of the Treasury releases the Treasury International Capital, or TIC, report. This report shows how much U.S. debt is held by foreign entities, broken down by country. According to the latest available data, as of January 2025, foreign holdings of U.S. Treasuries stood at $8.526 trillion. That figure was roughly unchanged from the month before, but still up by 7.2% compared to the previous year. But those headline numbers don't tell the whole story. When you look at the 3-month period between November 2024 and January 2025, a very different trend appears beneath the surface. During this time, foreign governments and financial centers reduced their holdings in U.S. Treasury securities by an estimated $390 billion. This marked one of the largest sell-offs in recent memory, and was notable not just for its size, but for how widespread and synchronized it was. It wasn't just one or two countries making adjustments, it was a broad global shift. Among the largest sellers during this period was Brazil, which sold off approximately $55.9 billion in U.S. Treasury securities. Ireland, a key financial hub for multinational corporations, followed closely, cutting $42 billion. The Cayman Islands, often used by investment funds and hedge funds to route capital, reduced its holdings by $41.2 billion. Canada, a traditionally strong economic ally of the United States, also pulled back, selling $37 billion worth of U.S. debt. Other major reductions came from Norway, which offloaded $35.6 billion, and India, which sold $34.9 billion. Even long-term and consistent holders like Japan and China trimmed their positions, albeit more modestly. Both countries reduced their U.S. Treasury holdings by $7.8 billion each during this window, a small fraction of their total exposure, but significant given the timing and coordination. In total, the sell-off covered a wide geographic range. Countries in North America, Europe, Asia, and the Middle East all participated. Some of the other notable names included Belgium, Switzerland, Luxembourg, Hong Kong, France, and even Taiwan, typically known for its steady and predictable approach to foreign reserves. The scale and consistency of these moves raised questions about whether we are seeing a short-term repositioning or the early signs of a longer-term reassessment. There are several factors that may help explain this sudden shift. One of the biggest is the interest rate environment in the United States. Over the past couple of years, the U.S. Federal Reserve has been aggressively raising interest rates to combat inflation. As rates rise, newly issued Treasury securities come with higher yields, which makes older bonds with lower interest less attractive. Investors may decide to sell their existing holdings, even at a loss, in order to free up capital to purchase the newer, higher-yielding securities. This kind of repositioning is fairly common in financial markets, but what makes this recent sell-off different is its global scale and the participation of countries that typically maintain stable holdings regardless of market conditions. Another factor at play is currency volatility. The strength of the U.S. dollar has fluctuated considerably in recent months, largely due to shifting economic conditions, monetary policy decisions, and changes in global capital flows. When the dollar is strong, it becomes more expensive for foreign governments to service their U.S. dollar-denominated assets or debt. In such cases, some may opt to reduce their exposure, especially if their own currencies are under pressure. But beyond economic calculations, there may be deeper, more structural forces behind the trend. Geopolitical uncertainty has become a much larger part of the global investment landscape. Ongoing tensions between the United States and China, the aftermath of the Russia-Ukraine war, and concerns about the increasing use of financial tools, such as sanctions and asset freezes, as instruments of political power have made many countries rethink their reliance on U.S. financial infrastructure. Some central banks and sovereign wealth funds are seeking to diversify their reserves not just to improve returns, but to reduce potential vulnerability. If the U.S. decides to sanction a country or restrict access to its financial system, any assets held within that system, including U.S. Treasuries, could be at risk. The idea of weaponized finance, once a theoretical concept, has now become a real consideration for policymakers around the world. Countries are responding by diversifying their foreign reserves. This might include shifting some holdings into gold, euros, or other major currencies. It could also involve investing more in assets denominated in their own currency or in those of trusted trading partners. While U.S. Treasuries are still viewed as low risk in terms of credit quality, the broader definition of risk is expanding to include political and strategic factors. It's also worth mentioning that the United States is currently facing record levels of national debt. As of early 2025, U.S. national debt has surpassed $34 trillion. While the U.S. has never defaulted and demand for treasuries remains strong, concerns about long-term fiscal sustainability are becoming harder to ignore. Persistent budget deficits, rising interest costs, and political disagreements over government spending and debt limits all contribute to a sense of unease among international investors. Interestingly, some financial analysts believe that part of the recent sell-off may also be linked to the political climate in the U.S. With the return of Donald Trump to the presidency in January 2025, some foreign governments may be bracing for a shift in economic policy, trade relationships, and geopolitical alliances. Trump's first term in office was marked by a more unilateral and sometimes unpredictable approach to international relations, and there are expectations that his second term could bring more of the same. For countries that value long-term stability and predictability in their investments, this kind of political uncertainty can be a reason to scale back exposure. Selling treasuries is one way to hedge against that uncertainty, not necessarily out of panic, but as part of a broader strategy to manage risk and maintain flexibility. At the same time, there's no clear indication that the world is abandoning U.S. treasuries altogether. The overall size of foreign holdings remains high, and key countries like Japan and China are still deeply invested. The recent sell-off may represent more of a rebalancing than a full exit. It's possible that countries are adjusting the composition of their reserves to better reflect the current environment, while still maintaining significant stakes in U.S. debt. So, what does all of this mean for the average person? In the short term, not much will change. U.S. debt continues to be in high demand, and the government has no trouble finding buyers for its securities. But over the longer term, shifts like these could affect interest rates, inflation, and the government's ability to borrow cheaply. If foreign demand for U.S. debt weakens substantially, the U.S. may need to offer higher yields to attract buyers, which could raise borrowing costs across the economy. Trump's return to power has reignited global concerns about the predictability of U.S. policy, particularly when it comes to trade, monetary stability, and international diplomacy. For investors and foreign central banks, predictability is a major factor when deciding where to allocate reserves. U.S. Treasuries, for decades, have been viewed as the ultimate safe haven, stable, liquid, and backed by the full faith and credit of the United States government. But now, that perception is being tested. One of Trump's first major policy announcements after returning to office was the reintroduction of reciprocal tariffs. The idea is straightforward on the surface. If another country imposes a higher tariff on U.S. goods, the United States will match or exceed that rate on their exports. Supporters argue that it's about leveling the playing field and protecting American workers. Critics see it as a potentially destabilizing move that could trigger retaliatory measures and reignite trade wars that were only recently de-escalated. This announcement alone created a sense of caution among international investors. Trade tensions can weigh heavily on markets. They introduce uncertainty into global supply chains and affect the performance of key sectors like agriculture, manufacturing, and technology, all of which are interconnected with the bond market in one way or another. If trade slows, so does growth. And if growth slows, the economic fundamentals backing U.S. debt could be called into question. Beyond tariffs, Trump has also renewed his criticism of the Federal Reserve, continuing a pattern from his first term. He's expressed frustration with the Fed's decisions on interest rates and monetary tightening, suggesting that central bankers are either misguided or actively working against American interests. While such rhetoric may play well with parts of his political base, it raises red flags for institutional investors. The Federal Reserve is supposed to operate independently of political pressure. Its credibility rests on the idea that it will make decisions based on data and long-term stability, not short-term political goals. If investors sense that this independence is under threat, they may worry that future policy decisions will be less predictable, or worse, influenced by the demands of the White House. That kind of uncertainty doesn't sit well with large foreign holders of U.S. debt. There's also the broader issue of fiscal policy. During his campaign and early weeks back in office, Trump reaffirmed his commitment to major tax cuts and increased spending on defense and infrastructure. These kinds of policies can widen the budget deficit, especially when combined with slower growth and a high interest rate environment. The U.S. is already facing record levels of debt, with over $34 trillion on the books as of early 2025. Foreign investors are increasingly asking how sustainable that trajectory is. Many of the countries that reduced their U.S. Treasury holdings in recent months are also countries that have been historically cautious about political risk. Japan and China, the two largest foreign holders of U.S. debt, both trimmed their positions, modestly but noticeably. Other countries like Brazil, Ireland, Canada, and India made much steeper cuts. These were not just financial decisions. They were strategic. By reducing their exposure to U.S. assets, these countries are trying to insulate themselves from potential shocks. They're not necessarily predicting a crisis. Rather, they're hedging against one. For central banks, that kind of caution is a responsible move, especially when political conditions shift as dramatically as they have in the U.S. Another concern, particularly among U.S. allies, is the potential use of financial tools as instruments of foreign policy. Under Trump's previous administration, the U.S. frequently used sanctions, asset freezes, and access to the dollar-based financial system as ways to influence or punish other countries. These tools were effective, but they also sent a clear message. If you fall out of favor with Washington, your economic stability could be at risk. That message has lingered. Countries that rely heavily on the U.S. financial system, whether through trade, investment, or debt holdings, are now taking steps to reduce their vulnerability. Some are diversifying into gold. Others are shifting reserves toward the euro, the Chinese renminbi, or even alternative digital currencies. There is a growing sense that over-reliance on dollar-denominated assets may not be the safest long-term strategy. This trend, sometimes referred to as de-dollarization, is still in its early stages. The dollar remains dominant, and U.S. Treasuries are still considered one of the most liquid and reliable assets in the world. But the coordinated nature of the recent sell-off suggests that the world's largest holders of U.S. debt are watching closely. They're adjusting their strategies in response to changing conditions, not just in the bond market, but in Washington as well. What makes this particularly significant is how widespread the shift has been. It's not just countries with adversarial relationships with the U.S. that are reducing their exposure. It includes close allies, Canada, the United Kingdom, South Korea, all of whom trimmed their U.S. Treasury holdings during the same 3-month period. The coordinated nature of these moves makes it hard to dismiss as coincidence. Many analysts believe that this isn't about short-term profit-taking or speculative positioning. It's about structural changes in how foreign governments perceive risk. And with Trump back in the White House, many see a higher degree of risk, not necessarily in terms of credit default, but in terms of policy unpredictability and the potential weaponization of financial systems. So far, markets have absorbed the changes without any major disruption. Bond yields have remained relatively stable, and there continues to be strong demand from domestic investors and institutions. But the underlying message is clear. Foreign governments are preparing for a more volatile, less cooperative international environment. Trump's America First agenda, for all its domestic political appeal, is viewed by many outside the U.S. as inward-looking and confrontational. That doesn't mean countries will stop doing business with the United States, but it does mean they may start doing it differently, with more caution, more diversification, and less automatic trust in traditional financial instruments like U.S. Treasuries. The recent reductions in foreign holdings of U.S. debt aren't just about interest rates or currency markets. They're about geopolitics, strategy, and a shifting global perception of the United States under a returning president whose policies have, in the past, disrupted long-standing norms. Whether this is a temporary adjustment or the beginning of a longer-term realignment remains to be seen. But for now, one thing is clear. The rest of the world is watching, and they're not waiting passively to see how things play out. They're already making moves.